Something shifted in the markets this week. Not the kind of shift that makes headlines or triggers panic, but the kind that reveals what's really happening beneath the surface. JPMorgan, one of the world's largest and most sophisticated financial institutions, recently closed 633 short positions in a particular asset class. The timing? Right as prices hit what many analysts now believe was a cyclical bottom. This isn't about conspiracy. This isn't about vilifying institutions. This is about reading market signals, the way experienced investors have done for generations. When a major bank reverses a significant bearish position at the precise moment sentiment reaches maximum pessimism, it tells us something. It tells us that the smart money is repositioning. It tells us that what looks like chaos to retail investors often looks like opportunity to institutions with longer time horizons. If you already hold this asset, this script will help you understand what this shift means for your position and how to think about the road ahead. If you've been watching from the sidelines, trying to determine if now is the time to enter, we'll explore that question with the seriousness it deserves. But more importantly, we're going to examine why this moment matters in the context of the larger economic picture. Because what's happening with one asset class is connected to profound changes in monetary policy, debt dynamics, inflation trends, and the structural forces that shape every market cycle. Let's start by understanding what actually happened, and then we'll zoom out to see the bigger picture that most people are missing. First, the facts. According to recent regulatory filings, JPMorgan closed a substantial number of short positions in what appears to be precious metals or cryptocurrency markets. The exact timing coincided with price levels that many technical analysts identified as significant support zones. A short position, for those newer to markets, is essentially a bet that an asset's price will fall. When you short something, you profit if the price goes down and lose if it goes up. Closing a short position means buying back that asset, which creates buying pressure in the market. When institutions close large short positions, especially all at once, it often signals a reassessment of risk. Either they've reached their profit targets, or more interestingly, they've determined that continuing to bet against the asset carries too much downside risk. The timing matters because institutional traders don't typically close positions at bottoms unless they believe the trend is about to reverse. They're not sentimental. They're not loyal to any position. They follow data, flow, and probability. So when we see a major bank exit a bearish position right as retail sentiment reaches peak negativity, we should pay attention. This doesn't mean prices will immediately skyrocket. It means the balance of probability may be shifting. The broader context makes this even more interesting. We're not in a normal economic environment. We're in a period of unprecedented monetary experimentation, with debt levels that would have been unthinkable a generation ago, and with inflationary pressures that refuse to behave the way central bankers expected. To understand why JPMorgan's move matters, we need to understand the environment in which it happened. Let's talk about where we actually are in the economic cycle, because most people are operating with outdated assumptions. For over a decade, we lived in a world of artificially suppressed interest rates. Central banks around the world printed unprecedented amounts of money. Governments spent far beyond their tax revenues. The assumption was that this could continue indefinitely without meaningful consequences. That assumption is now being tested in real time. Inflation, which many economists declared dead in the 2010s, returned with force. Central banks responded by raising interest rates faster than at any point in recent history. This created immediate stress in the financial system. Higher interest rates increased the cost of servicing debt. And when government debt is measured in tens of trillions of dollars, even small rate increases translate to hundreds of billions in additional annual interest payments. At the same time, higher rates make bonds more attractive relative to stocks, real estate, and speculative assets. They strengthen the currency, which can hurt exports and corporate profits. They slow consumer spending and business investment. This is Economics 101. But what's not in the textbooks is what happens when you combine historically high debt levels with rising rates, while simultaneously dealing with persistent inflation and geopolitical instability. We're in uncharted territory. Not crisis territory necessarily, but definitely uncertain territory. And uncertainty is precisely when smart investors start looking for assets that have historically served as stores of value during periods of monetary stress. Large financial institutions don't make decisions based on emotion or ideology. They make decisions based on risk-adjusted expected returns. When JPMorgan or any major bank holds a short position, they're constantly evaluating whether that position still makes sense given changing conditions. They're looking at technical levels, fundamental catalysts, correlation with other assets, and macro trends. Closing hundreds of short positions simultaneously suggests a fundamental reassessment occurred. Something in their models changed, something in their outlook shifted. This doesn't mean they've suddenly become believers in the asset they were shorting. It means they've determined that the risk-reward of remaining short has deteriorated. Think about it from their perspective. If you're short an asset and it's already fallen significantly, much of your potential profit has been realized. Meanwhile, if economic conditions are shifting in a way that could support a rebound, your downside risk increases substantially. Professional traders talk about asymmetric risk. They want situations where potential gains significantly outweigh potential losses. When that equation flips, they exit, regardless of their previous conviction. This is different from how retail investors typically operate. Retail investors often become more committed to a position the longer they hold it. They develop emotional attachment. They rationalize losses and become defensive about their choices. Institutions are ruthlessly pragmatic. If the probabilities change, they change their positions. This discipline is a large part of why they survive and compound wealth over decades. Market history offers valuable perspective, even though every cycle is unique in its details. Throughout financial history, major market turns often happen when sentiment reaches extremes and institutional positioning shifts before retail investors realize what's happening. Think back to 2008. As the financial crisis unfolded, many sophisticated investors began accumulating quality assets in late 2008 and early 2009, even though the headlines were catastrophic and retail sentiment was at historic lows. Or consider the gold market in the early 2000s. After a 2-decade bear market, gold began a sustained bull run just as most investors had given up on it entirely. Institutions quietly accumulated while retail investors were chasing technology stocks. The pattern repeats because human psychology remains constant. Fear and greed drive retail behavior. Probability and value drive institutional behavior. This doesn't mean institutions are always right. They make mistakes constantly. But they have advantages in information, resources, and emotional discipline that retail investors must acknowledge and learn from. When we see a major institution reverse a significant position at what appears to be a cyclical bottom, historical precedent suggests taking notice, not blindly following, but analyzing what they might be seeing that others are missing. Let's discuss one of the most misunderstood forces in today's economy, inflation and what it means for different asset classes. Many people think inflation is simply rising prices. That's the effect, not the cause. Inflation is fundamentally a monetary phenomenon, too much currency chasing too few goods and services. When central banks create enormous amounts of new money, as they did during the pandemic and throughout the 2010s, that money doesn't disappear. It circulates through the economy, bidding up prices. Central banks tried to combat this by raising interest rates, which is supposed to slow economic activity and reduce demand. But there's a problem with this approach when government debt is extremely high. Higher interest rates make it more expensive to service existing debt. For governments running trillion-dollar deficits, this creates an impossible choice. Either accept much higher interest costs, which require more borrowing, or find ways to keep rates from rising too much. This tension between fighting inflation and managing debt is one of the defining challenges of this economic era. And it creates a specific dynamic for certain asset classes. Assets that have historically served as stores of value during periods of currency debasement become more attractive when investors lose confidence in the purchasing power of fiat money. This isn't speculation or theory. This is pattern recognition based on thousands of years of monetary history. When faith in currency stability wavers, investors seek alternatives. Sometimes that's real estate, sometimes it's commodities. Often it includes precious metals and, more recently, scarce digital assets. If you're already holding the asset in question, whether it's gold, silver, Bitcoin, or another store of value investment, JPMorgan's position reversal should inform how you think about your holdings, but it shouldn't dictate your actions. First, understand that institutional repositioning often happens before retail investors see confirmation in price. You might not see immediate validation of this shift. The market might remain choppy. Sentiment might stay negative for weeks or even months. This is normal. Major trend reversals don't announce themselves clearly. They emerge gradually from patterns that only become obvious in hindsight. Your job as a holder is to continually reassess your thesis. Why did you buy this asset in the first place? Has that reason changed? Are the fundamental conditions that attracted you to this investment still present, or have they deteriorated? If your original thesis was based on concerns about monetary policy, inflation, or economic uncertainty, ask yourself honestly, have those concerns diminished or intensified? The institutional repositioning suggests that sophisticated players believe the risk-reward has shifted in favor of holders, but you must make your own determination based on your specific situation, risk tolerance, and time horizon. One thing is certain. Emotional decision-making rarely serves investors well. If you're holding this asset because you believe in its long-term value proposition, a few weeks or months of price volatility shouldn't shake that conviction. Conversely, if you're holding because you hoped for quick gains and now you're just trying to break even, you might need to reconsider your approach entirely. If you've been watching this asset but haven't taken a position, the institutional shift creates an interesting moment for reflection. The best time to buy any asset is when sentiment is pessimistic, fundamentals are solid, and prices reflect maximum negative assumption. The worst time to buy is when everyone is euphoric, fundamentals are weakening, and prices reflect maximum optimism. Right now, by most measures, sentiment in many alternative assets remains quite negative. Retail interest is low, media coverage is skeptical, the general public has largely moved on to other stories. Meanwhile, institutional players appear to be repositioning away from bearish bets. This disconnect between retail sentiment and institutional positioning is often where opportunities exist. But, and this is critical, recognizing an opportunity doesn't mean rushing in blindly. It means doing serious homework. Ask yourself what percentage of your investable assets could reasonably be allocated to this type of holding. Consider your age, income stability, existing portfolio composition, and genuine risk tolerance. If you've never held this asset before, this isn't the moment to overcommit out of fear of missing out. This is the moment to educate yourself deeply. Start with a small position if appropriate, and commit to learning how this asset behaves across different market conditions. The institutions closing short positions took years to build their analytical capabilities and risk management frameworks. You can't replicate that overnight, but you can start building disciplined habits today. Let's examine an uncomfortable truth that has profound implications for every investor. Global debt, government, corporate, and household, has reached levels that are mathematically impossible to repay through conventional economic growth alone. We're not talking about temporary deficits that will be corrected during the next boom. We're talking about structural imbalances that have been building for decades and are now approaching inflection points. When debt reaches these levels, governments face limited options. They can attempt austerity, cutting spending and raising taxes, which is politically difficult and economically painful. They can default, which destroys trust and access to future credit. Or they can inflate, gradually eroding the real value of their debt obligations. History shows that inflation is almost always the preferred choice because it's politically easier and economically less disruptive in the short term. But inflation has consequences. It transfers wealth from savers to debtors. It punishes those who hold cash and fixed income instruments. It creates social tension as purchasing power declines. Smart investors understand that in an inflationary environment, the worst strategy is holding assets that are denominated in the very currency being devalued. This is why certain asset classes become more attractive during periods of monetary stress. They're not growing in value per se. They're maintaining purchasing power while the currency loses value around them. JPMorgan closing short positions suggests that their analysts may be acknowledging this dynamic more seriously than they did previously. Understanding market psychology is just as important as understanding economics. Markets don't move in straight lines. They cycle through phases of optimism and pessimism, euphoria and despair, greed and fear. The typical retail investor experiences these cycles emotionally. They buy when everyone else is buying and prices are high, then sell when everyone else is selling and prices are low. This behavior guarantees suboptimal results. Professional investors train themselves to recognize where we are in the emotional cycle and to act counter to the prevailing mood. Right now, we're clearly in a phase of pessimism regarding alternative assets. Media coverage is negative. Social media is quiet. Google search trends are down. Retail investment accounts show low activity. This is actually a healthy sign from a contrarian perspective. It means the weak hands have sold. It means expectations are low. It means negative news is largely priced in. Institutional repositioning at this stage of the cycle is consistent with how smart money typically operates. They accumulate when others are despondent and distribute when others are euphoric. This doesn't guarantee immediate gains. Bottoms can be lengthy processes, but it does suggest that the risk-reward equation may be shifting. For investors, the lesson is clear. Your emotions are usually telling you to do the opposite of what's strategically optimal. Learning to recognize and manage those emotions is perhaps the most valuable skill you can develop. This section might be the most important of this entire analysis. Let's discuss what disciplined investors should not do in response to this information. First, don't interpret institutional repositioning as a signal to immediately overcommit to any asset. There's a massive difference between recognizing a potentially favorable setup and betting your entire portfolio on a particular outcome. Second, don't abandon your existing investment strategy based on one data point. If you have a thoughtful allocation across various asset classes, don't dismantle it because of one institution's actions. Third, don't use leverage or borrowed money to invest based on this information. Leverage turns manageable losses into catastrophic ones. Even if the directional thesis is correct, poor timing with leverage can destroy your capital. Fourth, don't follow social media hype or online influencers who transform institutional positioning into guaranteed predictions. The financial world is complex. Anyone claiming certainty about future outcomes is either ignorant or dishonest. Fifth, don't invest money you need in the near term. Alternative assets can be volatile, If you need funds within the next year or two for important life expenses, those funds should be in stable, liquid investments, not speculative positions. Sixth, don't stop doing your own research. This analysis provides perspective, but your specific situation, goals, and risk tolerance are unique. Generic advice, no matter how thoughtful, must be adapted to your individual circumstances. Seventh, don't assume that because one institution repositioned, all others have done the same. Markets are heterogeneous. Different players have different time horizons, mandates, and risk assessments. Finally, don't let fear of missing out drive your decisions. FOMO is one of the most destructive forces in investing. There will always be opportunities. Missing one doesn't matter if you preserve capital and stay disciplined. The implications of institutional repositioning extend beyond any single asset class. When major banks shift their exposure, it often reflects a broader reassessment of systemic risk. They're not just thinking about one investment. They're thinking about how different scenarios would affect their entire portfolio. If JPMorgan and other institutions are reducing bearish bets on alternative stores of value, it suggests they may be increasingly concerned about traditional market dynamics. Perhaps they're worried about currency stability. Perhaps they see inflation proving more persistent than central banks expected. Perhaps they're hedging against tail risks that seem remote but would be catastrophic. This kind of positioning is relevant for anyone with savings and investments, regardless of whether they hold the specific asset being discussed. It suggests that a period of relative stability may be giving way to a period of greater volatility and uncertainty. It suggests that correlations between different asset classes might shift. It suggests that the strategies that worked for the past decade might not work for the next one. For diversified investors, this environment reinforces the value of true diversification, not just holding multiple stocks, but holding genuinely different asset classes that respond differently to various economic scenarios. It also reinforces the importance of regularly rebalancing, reviewing allocation, and ensuring that your portfolio is positioned for the world as it is, not the world as it was. One concept that's crucial to understanding why certain assets attract institutional interest during uncertain times is scarcity. In an era where central banks can create unlimited amounts of currency, genuinely scarce assets become more valuable. This is not theoretical, it's mathematical. If the supply of something cannot be arbitrarily increased while the supply of money is increasing substantially, the price of that scarce asset must rise in monetary terms to maintain equilibrium. This is why precious metals have served as stores of value throughout history. Their supply is limited by geology and mining economics. No government can decree more gold into existence. Similar logic applies to modern digital assets with fixed supply schedules. Whether you personally believe in them or not, the mathematics of scarcity combined with growing demand creates predictable price pressures. Institutional investors understand this dynamic deeply. They're not romantic about gold or philosophical about decentralization. They're pragmatic about supply, demand, and purchasing power preservation. When these institutions reduce short positions in scarce assets during periods of monetary expansion, they're acknowledging that the fundamental supply-demand equation favors holders over skeptics. This doesn't mean prices will rise smoothly or immediately, but it does mean the underlying forces support long-term value appreciation. Let's return to the interest rate dilemma because it's central to understanding the macro environment. Central banks raised rates aggressively to combat inflation. This policy worked in some respects. It slowed economic activity and cooled certain price pressures. But it also created enormous stress on governments, corporations, and households carrying substantial debt. And critically, it threatened to invert the yield curve and trigger recession warnings. Now central banks face an impossible choice. If they keep rates high, they risk recession, banking stress, and debt crises. If they lower rates too quickly, they risk reigniting inflation and losing credibility. The most likely outcome is that rates will need to remain higher than the ultra-low levels of the 2010s, but probably can't stay at current restrictive levels indefinitely without causing serious economic damage. This creates a challenging environment for traditional fixed-income investors. Bond yields might not keep pace with actual inflation. Cash might lose purchasing power. Traditional safe havens might not provide the protection they historically offered. In this environment, alternative assets that aren't tied to any government's monetary policy become more interesting to institutional investors. They're not replacing traditional holdings entirely, but they're adding them as portfolio diversifiers and inflation hedges. JPMorgan's repositioning could reflect this strategic shift from pure skepticism to pragmatic diversification. It's important to note that these dynamics aren't limited to the United States. Central banks around the world engaged in similar monetary expansion. Debt levels are problematic in Europe, Japan, and many emerging markets. Currency pressures are global phenomena. When the US dollar strengthens significantly, as it did during the aggressive rate hiking cycle, it creates enormous stress for countries that borrow in dollars but earn revenue in local currencies. This can trigger currency crises, capital flight, and economic instability. Conversely, When the dollar weakens, it can temporarily relieve these pressures, but often signals concerns about U.S. fiscal sustainability. Global investors must navigate this complex currency landscape, while also managing exposure to different economic cycles, regulatory environments, and geopolitical risks. Alternative assets that aren't tied to any single nation's policy decisions offer potential diversification benefits in this multipolar, uncertain world. Institutional investors with global mandates understand this better than most. When they reposition, they're often responding to global dynamics that might not be immediately visible to investors focused only on domestic conditions. One crucial difference between successful long-term investors and those who consistently underperform is time horizon. Short-term traders try to predict what will happen in days or weeks. This is extraordinarily difficult and often amounts to sophisticated gambling. Long-term investors focus on probabilities over months, years, and decades. They understand that short-term volatility is noise, while long-term trends are signal. JPMorgan's repositioning likely reflects a longer-term reassessment, not a bet on next week's price action. Institutions think in quarters and years, not in daily candles. If you're evaluating this information, you must ask yourself what your time horizon is. If you need your money in 6 months, institutional positioning is largely irrelevant to you. Your focus should be on capital preservation and liquidity. But if you're investing capital you won't need for 5, 10, or 20 years, then understanding long-term structural forces becomes paramount. This is where amateur investors often go wrong. They hear information relevant to long-term positioning and treat it as a signal for short-term speculation. The result is predictable disappointment. Match your strategy to your actual time horizon. If you're a long-term investor, learn to ignore short-term volatility and focus on whether the fundamental thesis remains intact. Let's address the provocative subtitle, "The Crisis is Here." This phrasing could easily veer into fear-mongering, which serves no one. But there's a way to discuss crisis dynamics responsibly. A crisis, in the economic sense, is simply a moment when existing structures are tested and potentially fail or transform. It's not necessarily catastrophic. It's often evolutionary. We are objectively in a period where long-standing assumptions about debt, monetary policy, and economic growth are being challenged. This creates stress. Stress reveals weaknesses. Weaknesses eventually must be addressed, either through reform or failure. The crisis isn't necessarily an imminent market crash or currency collapse. It's the ongoing tension between unsustainable policies and economic reality. Smart investors don't panic about this. They prepare for it. They ensure their portfolios can withstand various outcomes. They maintain liquidity for opportunities. They avoid excessive leverage that could force them to sell at disadvantageous times. Crisis can be opportunity for those positioned correctly with patience and discipline. This is what Warren Buffett meant when he said to be fearful when others are greedy and greedy when others are fearful. Institutional repositioning at potential bottoms suggests preparation for opportunity, not panic about collapse. Rather than telling you exactly what to do, which would be inappropriate without knowing your situation, let's discuss how to build a framework for making these decisions yourself. First, clearly define your financial goals. Are you saving for retirement decades away? Building an emergency fund? Growing wealth for legacy purposes? Different goals require different strategies. Second, honestly assess your risk tolerance. Not what you think it should be, but what it actually is. Can you watch an investment lose 30% without panic selling? If not, you need a more conservative allocation. Third, educate yourself deeply about any asset class before investing significantly. Understanding why something moves up or down helps you stay calm during volatility. Fourth, develop a rules-based approach to allocation. Perhaps you decide that alternative assets should represent no more than 10 to 20% of your portfolio. This rule prevents emotional overcommitment during either euphoria or despair. Fifth, create a rebalancing discipline. If one asset class surges, trim it back to your target allocation. If it falls dramatically, add to it. This forces you to buy low and sell high. Sixth, maintain adequate liquidity. Always have cash reserves for emergencies and opportunities. Never be forced to sell investments at inopportune times due to cash needs. Seventh, stay informed about macro trends without obsessing over daily news. Quarterly reviews are probably sufficient for most long-term investors. This framework approach serves you far better than reacting to each new data point or institutional repositioning. Let's acknowledge something uncomfortable. Institutions have information advantages that retail investors cannot fully overcome. They have access to expensive research, sophisticated modeling, direct communication with regulators and policymakers, and trading technology that processes information at speeds humans cannot match. Does this mean retail investors are doomed to underperform? Not necessarily. Retail investors have different advantages. They have flexibility that large institutions lack. They can hold positions for decades without quarterly performance pressures. They can invest in smaller opportunities that institutions ignore. They have no mandate forcing them into certain investments. The key is understanding what game you're actually playing. If you're trying to outtrade Goldman Sachs on short-term moves, you'll lose. But if you're building long-term wealth through patient compounding in sound assets, you can absolutely succeed. Observing institutional positioning, like JPMorgan's short position reversal, is valuable not as a trading signal, but as information about how sophisticated players are reassessing risk and opportunity. Use this information to inform your thinking, not to dictate your actions. Let it prompt deeper analysis rather than immediate reactions. One of the most important principles in investing is the distinction between preparing and predicting. Predicting involves claiming to know what will happen. This is hubris. Markets are complex adaptive systems with countless variables. Anyone claiming to know the future with certainty is either deluded or selling something. Preparing involves acknowledging multiple possible futures and positioning to do reasonably well across various scenarios. This is wisdom. JPMorgan closing short positions doesn't predict that prices will surge. It suggests that their analysts believe the probability distribution of outcomes has shifted somewhat in favor of holders versus skeptics. You should approach this similarly. Don't predict. Prepare. Ask yourself, if alternative assets rally substantially over the next few years, would you regret having zero exposure? Conversely, if they remain volatile and uncertain, would you regret having overcommitted? The goal is to find a position where you can live with multiple outcomes, where you're not counting on any specific scenario to achieve your financial goals. This approach doesn't generate exciting content or bold predictions, but it generates sustainable wealth and peace of mind. Market history shows that the best accumulation periods are often the quietest. When Bitcoin was in the single and low double digits, barely anyone paid attention. When gold was below $300 per ounce in the early 2000s, it was declared a barbarous relic with no relevance to modern finance. The assets that generate the strongest long-term returns often spend years ignored, mocked, or forgotten before becoming obvious to the mainstream. Right now, alternative stores of value are in a relatively quiet phase. Retail enthusiasm has waned, media coverage is limited, social conversations have moved to other topics. This is typically when institutions quietly accumulate, not all at once, which would move prices against them, but gradually over months and years. Retail investors usually do the opposite. They ignore assets during quiet phases and only become interested when prices are rising and media coverage increases. By then, much of the opportunity has passed. If you believe in the long-term thesis for an asset class, quiet periods are gifts. They allow you to accumulate at more favorable prices without competition from emotional buyers. JPMorgan reducing short positions during a quiet period is consistent with how smart money operates. The question is whether you have the discipline to act similarly. If you're holding alternative assets and feeling uncertain about recent volatility, consider this perspective. Every asset class goes through cycles. Real estate crashes periodically. Stocks suffer bear markets. Bonds have multi-year drawdowns. Commodities can be dormant for decades. The assets that survive long-term are those with fundamental value propositions that remain relevant regardless of short-term price action. If you bought your holdings because you were concerned about monetary expansion, that concern hasn't disappeared. In fact, debt levels continue rising. Central banks remain in unprecedented territory. The structural issues that attracted you to these assets haven't been resolved. What has changed is that institutional players appear to be taking your concerns more seriously, as evidenced by their positioning shifts. This doesn't validate your decision. Markets validate or invalidate positions, not institutions. But it does suggest that your thesis wasn't as contrarian or foolish as skeptics might have claimed. Your job now is to stay disciplined. Don't become euphoric if prices rise. Don't panic if they remain volatile. Focus on whether your original investment thesis remains intact. If it does, short-term price movements are irrelevant to your long-term outcome. If it doesn't, then reassess, regardless of what institutions are doing. If you're on the sidelines evaluating whether to enter this asset class, here's what matters. Don't enter because of FOMO. Don't enter because you saw one YouTube video or read one article. Don't enter because your friend made money or because someone on social media promised gains. Enter, if at all, because you've done serious homework, because you understand the macro thesis, because you've evaluated how this fits into your broader financial plan, because you're prepared for volatility and committed to a multi-year time horizon. Start small. Get comfortable with how the asset behaves. Watch your emotional reactions. Add to your position gradually as your understanding deepens. Remember that institutional repositioning tells you something about probabilities, not certainties. It suggests the risk-reward may be shifting, not that gains are guaranteed. The best entry strategy for most people is dollar-cost averaging over time. This removes the pressure of timing and builds positions during both up and down moves. And critically, never invest more than you can afford to lose in any speculative or alternative asset. These should be satellite positions in a diversified portfolio, not core holdings that determine your financial security. We've covered substantial ground in this analysis. Let's distill it to what actually matters. JPMorgan closing 633 short positions at what appears to be a market bottom is a data point. A meaningful one, but just a data point. It suggests that sophisticated institutional analysts are reassessing their bearish stance on certain alternative assets. This reassessment is happening in the context of enormous debt, persistent inflation concerns, interest rate pressures, and global economic uncertainty. For holders, this should provide some confidence that your thesis isn't wildly off base, but it shouldn't change your fundamental strategy. Stay patient, stay disciplined, focus on long-term value, not short-term validation. For those considering entry, this represents a potentially interesting setup, but not a guaranteed opportunity. Do your homework. Start small. Think in years, not weeks. For everyone, the broader lesson is about reading market signals, understanding cycles, managing emotions, and making probability-based decisions rather than reactive ones. The financial world is entering a period of significant change. Old playbooks may not work. Assumptions that held for decades may be challenged. This creates both risk and opportunity. The investors who navigate this successfully won't be those who perfectly predicted the future. They'll be those who stayed informed, maintained discipline, managed risk intelligently, and refused to let fear or greed drive their decisions. JPMorgan's repositioning is interesting because it suggests even skeptics are acknowledging changed probabilities. But ultimately, your success depends on your own framework, education, and emotional control. Stay curious, stay skeptical, stay disciplined. And remember that understanding economic cycles and preparing thoughtfully matter far more than reacting to headlines or chasing momentum. The crisis, if we call it that, isn't something that suddenly arrives. It's a process we're living through. Your job is to position yourself thoughtfully for various outcomes, maintain the flexibility to adapt as conditions evolve, and resist the temptation to make emotional decisions during uncertain times. That's how wealth is preserved and built over decades. Not through bold predictions or perfect timing, but through consistent application of sound principles during both calm and chaos. Thank you for investing your time in this analysis. The fact that you watched this entire video suggests you take your financial education seriously. That discipline will serve you far better than any individual insight or data point ever could. Stay thoughtful, stay patient, and stay focused on what you can control, your knowledge, your discipline, and your emotional responses to market volatility. The road ahead is uncertain, but for prepared, educated investors, uncertainty always creates opportunity. Make sure you're in the second category.